Good morning, loonies, and what's up, YouTube? Welcome back to the Goofy Investing channel, where we talk about investing in the stock market. Today, we're going to be talking about Upwork on this Patreon promotional, which means that this will go on my Patreon first, and there will be a lag, and then eventually it will hit YouTube. Okay, so Upwork, a lot of questions, a lot to cover. Stock went down after earnings, so we're going to talk about that. We're going to talk about some more macro trends, things that I see, and we can explain price action and so forth, and what I'm doing about it, and how I feel. Excuse me, how I feel, and what I'm going to do about it. Okay, so Upwork, they reported earnings. All right. They reported earnings on the 7th, right? And they beat on EPS, but they missed on revenue. Okay. So this is a rarity for Upwork to miss, as you can see. And I wasn't even expecting them to miss, but I knew in the back of my mind there would be a possibility of a revenue miss or an EPS miss. And that's because of the macro and what I've been expecting for employment turbulence in Q3. If you have been following along, and my whole thesis, and this is why I'm positioning. Okay, the timing of the positioning, we'll talk about that as well later. All right, but let's get straight into the earnings and do analysis on the actual earnings. All right. Let me pull up this slide deck real quick. All right. So I have quarter over quarter comparisons in Q1. All right. So in Q1, this is the actual results as averse to Q2 right here. As you can see, pretty much GSV declined year over year, 2.7%. The gap gross margin is still increasing year over year, 100 basis points, which is 1%. And adjusted EBITDA has increased, and free cash flow has increased. Take rate has increased as well. Okay. So that's something to consider. All right. Those are results of year over year comparisons from quarter to quarter. All right. Now, let's look at some of the guidances that they've been putting out quarter to quarter. Q2, what they were guiding for Q2, pretty much, yeah. I mean, let's see if they hit their own guidance. Okay, they guided 190 million to 195 million. Let's go back here, go back to earnings, and see what they actually put up. All right. So they guided 193.13 million. All right. So that's what they reported. We'll go back to the actual slide deck. And they hit within that range. All right. Analysts had them reporting even more. So they missed by off consensus estimates from analysts. They missed by 41.06 thousand. Okay, slight miss. Okay, but is that the reason why the stock is down? Partially. Okay, but this is the main reason why the stock is down. All right, because their guidance they have lowered the guidance for the rest of the year. Okay, and this guidance is still in positive growth territory. Let's go back to their financials. Or before we do, let's look at it. So for the full year guidance that they're reporting is 735 to 745 million. We'll go back to financials and we'll go back to an annualized basis. All right. On the trailing, they're still at all-time highs as far as revenues are concerned. So there has never been a decline in the negative and reversal of the revenues. Okay. So that's something to consider. All right. So the miss. Okay. Going back to the miss, I think that they're fine. All right. If you, if now if they missed and they missed revenue and it was below the guidance number, all right, then I would be looking at management a little strange, like, hey, how come you guided this and you straight up missed below your own guidance estimate? Okay. And on top of it, how come you didn't put out a press release in advance to the earnings that you were going to miss? Okay. So that's that. But that was not the case. They guided for this range between 190 million and 195 million, and they reported. Let me go back to it. They reported 193.13 million. So they're within their range in the middle of their guidance. All right. So to me, like Wall Street estimates, consensus estimate through analysts, they missed their standard, but they did not miss their own metrics on their own guidance. Okay. So Wall Street can think what they think, and the shareholders can think what they think, and between the management and the shareholder and so forth. You have to understand Wall Street. Yes, that's who can push the stock. They can do their market makers, etc. They can reward the stock, push it up, so forth. Sure, that's how we get paid, right? As retail investors. Wall Street comes in, starts buying up the place, and we sell our shares off to them when the time comes at, whatever the individual investor assesses. Okay. So, and yeah, that's part of your analysis of who's going to buy this thing when it's time for me to sell. All right. So that's how I feel about the actual revenue miss. All right. Let's talk about EPS. All right. So they guided between 21 and 23 cents. We'll go back to earnings. They did 26 cents. There's the beat. But more importantly, let's look at comparisons on the actual guidance itself. All right. So original guidance for fiscal year for revenue for 2024 was 770 to 782 million. The new guidance that they guided down for is 735 to 745 million. Okay. Um, that's kind of steep because there's about 30, about 25 million below the low range of last quarter's yearly guidance. Okay. Not a showstopper. All right. I'm expecting turbulence. This is what happens if you have a macro as such. All right. Adjusted EBITDA. Same guidance, 140 to 150 million on adjusted EBITDA. Weighted shares outstanding. They have improved their yearly guidance. They upped the guidance for shares outstanding. All right. EPS comparisons, they've raised guidance on EPS. We went from 88 cents to 92 cents in Q2 reporting, and then in Q1 reporting, to now they're guiding 90 to 94 cents. All right. So, and then so forth. Same idea with the next quarter EPS guidance. 23 cents to 25 cents as averse to 21 to 23 cents from a quarter over quarter basis. All right. Stock-based comp. All right. This is one of those things to address the Bash. Shout out to Bash. All right. I know you're watching. All right. Stock-based compensation expense is expected to average slightly more than 20 million per quarter in 2024. Now they're guiding that stock-based compensation expense is expected to average less than 20 million per quarter in 2024. If we go back to free cash flows. Um, they did 33.5 million for the quarter, and now they're pretty much there is a lopsided. Um, we are past that threshold where free cash flows are going to start exceeding stock-based comp, and share repurchases are going to start becoming more effective in lowering the share count. All right. Um, and let me pull it up here. Let me see here. Here's our gap reconciliations in the actual slide deck. Now we're going to actually let's look at some financial analysis, and we'll start with the balance, or actually we'll go to the cash flows. Okay. Let me pull this over here like this. I'll just cover myself for a bit. Okay. So if we look at free cash flows on an annualized basis, all right, the company has been positive since 2020 in free cash flows. So this is a margin accretive free cash flow business, which I like any investor would like to see, quite frankly. Um, but on a quarterly basis, let's look in the search goal analysis. All right. Um, Here's our actual gap reconciliated free cash flows. Now, once again, why is the number different? Well, let's go back. All right. So these are adjusted free cash flows. All right. I think they forgot to put the adjusted part there. Anyway, either way, it's still over the 20 million a quarter. Where are these free cash flows coming from? How are we realizing them with Upwork? Well, let's go to the balance sheet. All right. So total cash and short-term investments increased about 7.1 million. All right. Cash and cash equivalents went from 24.7 million to 182.8 million in the recent quarter. A divestiture, there was a divestiture into from, how do you say, short-term investments to cash and cash equivalents. They probably purchased some yielding treasuries to contribute to the free cash flows. And we've also, yes, we've told from a total perspective, they increased the balance sheet a little bit. Yes, it's still down from a decrease from 555 million total. All right. Probably due to increased capital expenditures and research and development, which the company has guided that they are increasing capex to R&D. All right, so that's something to why are they increasing that? Well, um, they're increasing their spend on AI and innovative products to disrupt. And I want them to continue to do that. All right. Let's look at share count. All right. We're going to the income statement of the financial analysis piece on the financial statements. Um, so diluted weighted average shares decreased. All right. The buyback is kicking in, where we went from 143.7 million shares or what have you to 138.3. Okay. Pretty good, pretty good decrease considering it's a quarter over quarter comparison. All right. I expect the buyback to start kicking in more, um, and so forth. All right, let's look at some other stuff. All right, let's check out this video that I put out, which, quite frankly, is not aging too well, if you know what I mean. But let's listen to this real quick. Long-term adjusted EBITDA margin target of 35%. Looking at their gross profit margin, which is 75% and still expanding, mind you. I don't. There's plenty of margin to be had on the net income margin. I think that they can get 20 to 25%. There is no model. There is no mature model to model this after. Okay. All right, enough of that. Now here's the trick. All right. This is the advantage of being a YouTuber because you can do past records of what you've been guiding for yourself in your own target models, and the comparison changes in the metrics of today from as in comparison to the past, if you will. All right. So let's you see make a mental record of the actual margins. We had net income margin of 6.7% last quarter, an EBITDA margin of 4.17%. We'll go back. Let's look at the margins of today. All right. EBITDA is 7.28%, and they hit a net income margin of 10% flat. All right. This net income margin is really what matters. Okay. Management is guiding EBITDA margin with a 5-year target of 35%. All right. And and pretty much, why are they guiding EBITDA as averse to net income? Okay, well, they're guiding EBITDA because there is credit quality bank, how do you say, bank analysis, and the financial community. A lot of that goes into EBITDA. All right. And the credit quality will be the potential for a financial institution to loan money to Upwork, because they look at the interest before, or earnings before interest, taxes, depreciation, and amortization, because that is the layer of which that financial institution would earn and potentially earn from Upwork, because they would gain interest. It's their income before the interest. So um, if financial institution loans money to Upwork, they would capture claim in the I portion of the EBITDA. Okay, as an actual investor shareholder, net income is the way to go. The net income margin is the way to go, because it's calculated straight into your EPS to how much shares or how much earnings your shares are getting. Okay. So I expect net income margin to continue to expand as Upwork grows their EBITDA margin, and their free cash flow margin should expand too, 5.75, as averse to 3.06% quarter over quarter comparison. These are dramatic swings on the actual profitability metrics. Okay, let's pull up the position, or actually no, let's do some quick little analysis on my thesis. Okay, all right, this is big tech capital expenditures into AI, where in the over $50 billion combined with these actual four big tech companies. All right. And what is the main purpose, or one of the main purposes of AI? Well, I'll tell you, a lot of the main purposes of AI is to get rid of jobs, okay, to save money on their own capex, SG&A, and so forth. The big tech companies, a lot of them are aiming to try to reduce their workforce and create more efficiency and expand margins. All right, it's capitalism. All right. Sounds ugly, but it is what it is. Not all of it is completely centered towards replacing their own employees' workforce, but a big portion of that spend is dedicated towards that. All right. They're always going to have employees, sure, but they will have some shrink on the workforce to expand margins. All right. And Upwork is a workforce economy of scale, which is special to its own because they're the leader in that market. All right. Let's look at employee counts for these big tech companies. There's 1.5 million in Amazon. Microsoft's got 221,000. Google's got 180,000. Oracle is another one. They got 159,000. Apple 150,000. Tesla 140,000, and so forth and so forth. Okay. So the total employee count is 11.3 million. Okay. For 1,000 of these tech companies. All right. And you cannot count out different country tech companies because Upwork is expanded to a global presence, if you will. All right. So, my thesis: employment disruption with this AI spend, if there's realization in the AI capital expenditure, which I think there will be, but it will be in an incompetent manner that these big tech companies will lay people off, and they will probably find out, oh crap, we still need these people. And then the actual employees that were laid off, which are talented, which is a good talent pool, will make their way to Upwork, which is and become freelancers. Not all of them, but a big portion of them will. And I think that they will double. I think Upwork will probably double the count of the freelancers and so forth. All right. And I'm expecting employment turbulence to keep kicking in quarter after quarter. Um, Probably for the rest of the year, it'll get worse and worse. We'll get a slowdown in the consumer spending. And with the slowdown in the consumer spending, and due to the actual market cap size of these big tech companies, these big tech companies are probably going to say the capital expenditures for AI, the juice is not worth the squeeze. Okay, because you only have such a amount of TAM that you can capitalize off this new technological innovation and the actual timing of the efficiencies to where that actual capital expenditure for that technology would kick in for an ROI. Okay. So that's part of my thesis for Upwork. Let's pull up my position. All right. Currently, I have 400 shares. I'm going to get this up to 1,000 shares. If there was a time that I wanted Upwork to miss, it would have been this quarter because I'm building my position. I consider this a gift. Um, so whenever I invest, I do not invest for that quarter or even that year. So the money that I'm putting in any of these companies, I don't expect the actual uptrend and the realization or unrealized gains to happen or start happening until the next year to follow. So that's how I invest. I take 2024 and all my capital allocation invested towards stock is aimed on price targets in future year metrics. All right. So if I invest 10 grand into Upwork this year, I expect the performance to start next year. Okay. I'm keeping track of the mannerisms of management and how they're managing the company while I'm investing, but I am given more room because I don't invest into strength. I don't invest when the stock is going up, everything is good to go and everything's rosy and the stock already has a high multiple. I do the opposite as a contrarian. I invest when everything is going to hell, or it's probably a lack of better words, but when everything is going down, there's depression in that business sector, and I expect a change, a swing change over to the upside. And quite frankly, Upwork's downgrading of their own yearly guidance on revenue and what they're reporting now will support easier comps next year, to where when the comps come in next year, they will be even stronger and stronger. All right. This was a pretty long video. I'm not going to get into the reassess price targeting, but I'm still bullish on Upwork. My thesis is still intact. In fact, if anything, this is kind of demonstrating that even more so, the thesis is intact. The workforce and the economy has just not realized that Upwork is the answer. I believe it will happen. When will that happen? I'm probably projecting second half of 2025 when when we start getting into employees running to Upwork to become freelancers and companies admitting, oh crap, we need to hire more freelancers to compensate for the mistake that we made laying off. All right. And that capex will decrease, but that will probably come, that the money will probably come from this capex right here on these big tech companies. All right, I think Upwork will take a chunk of that capex. I think that's where the liquidity and funds are coming from. All right, when the time comes. All right. All right. Enough. I think I covered a lot here. Hope you got value out of this. If you are getting value out of this, subscribe, hit the like button, hit me up. Consider subscribing to my Patreon. Join like-minded investors. Get access to the hidden gem collection, and get access to different exclusive product spreadsheets where I give instructionals and more training instructionals to use those, all included in your Patreon price. Okay, and get more direct access to me. All right, with that being said, take it easy, loonies. Take it easy, YouTube. And until the next time.